December 1st, 2023. Coming into today, I thought that we were probably going to get a second leg up from this really strong spike. The reason being it's really strong. And if you look at like a 15-minute chart, oh, that's the yearly chart, my bad. If you look at like a 15-minute chart, you can see we got a strong pair of bull bars, and that's probably going to be enough for a second leg. And so the point being, when you get a strong spike like this, it's probably a breakout on a higher time frame. When you get breakouts on higher time frames, they usually, or just breakouts on any time frames, they usually lead to second legs. So breakouts on higher time frames usually lead to second legs and tradable swings on lower time frames. Bar one, a bear bar. On any day, there's a 20% chance that the first bar of the day is the low or high of the day. And today, that ended up being low of the day. There's no real way to know that in the moment, but it's an important stat. Bar two, a micro double bottom with bar one. You can see the tail on one and the tail on two. So we have a double bottom. Follow through for the bulls on bar three. But is bar three really enough follow through? If you really think about it, it's not a very big bar. The body is, barely the size of the body of bar two. If you bought above two, you probably actually wanted to see a bar more like 21. If you're buying above something like this, you want to get swept into a trend. You want to get, a really big follow through bar. So is three a good bar for the bulls? Yeah, it is. But you want to see, a bigger bar for the bulls that's more likely to get even more follow through rather than just kind of a small bar. And I think the small bar is the reason why you get bad follow through on bar four. And if you bought above two, once you see four, you're really not all that confident in this rally. Generally, when you get a doji in a buy the close rally, the buy the close rally is going to end within a couple of bars. And it's disappointing for the bulls that we ended up trading below bar four during bar five. Once we do that, this could just be a second leg up or some sort of second leg trap, and bad follow through on six, and then a big breakout on seven. I thought seven was interesting. It was essentially just a vacuum test of yesterday's high. And one of the reasons I thought we had to test yesterday's high was because of the daily chart. It's a high one on the daily chart, and I thought that we were going to get bad follow through. So I thought that the traders who bought above this bar, November 30th, were going to be disappointed in the follow through they got on the first. And obviously I was wrong. They ended up getting good follow through, but I thought that was relatively low probability that they were going to get that kind of follow through because it's an overall trading range, right? If you just look at the past, 20 days or so, it's overall a trading range, and it's more visible on the daily chart. This is a tight trading range. So I thought the breakout would fail. And I still think it might. I'd be surprised if we got another big bull follow through bar on Monday. But another important thing was this was a bull channel. So from here, essentially, read channel. And when you get a big breakout of a channel, 75 or 70% chance that you're going to test the other side of the channel within a couple of bars. So you can see we got a failure on bar 8, and so 70% chance we're probably going to get to the other side of the channel at some point. Additionally, it's a big wedge. 1, pullback, 2, pullback, 3, and a nested wedge on today. 1, pullback, 2, pullback, 3. So it's a nested wedge top and an inside bar on bar 8. So I don't think bar 8's the worst sell. It's also, a failure of failed breakout of yesterday's high. So you could probably sell below bar 8. The problem is that, the channel up is relatively tight, and, you're kind of hoping for a stronger close on bar 8, but it was a bit disappointing, to get a bar that wasn't even closing below, or it might have been below its midpoint, but, it's around its midpoint is what's important. Follow through for the bears on bar 9, but a tail on the bottom, which was, minorly disappointing. You want to sell below 9, but you want to sell, there's really strong close. And it wouldn't be as bothersome if 8 was a stronger close, but 8 wasn't a stronger close. So, it could be down on 8, up on 8, down on 9, 1 pullback, 2, potential second leg trap. However, I think it's probably okay to sell the close on 9. It's just that this is looking a lot more like a trading range than a trend. 10, bad follow through, big doji bar. You can see bears are scalping. They got a little more than 5 points and they scalped out. Did these traders make 10 points? The high is 68.75. Did it get to 78.75? Yeah, okay, got well past it. So bulls able to make 10 points. Bears trying to make 10 points. Let's see I don't know if they made. Yep, they were able to make 10 points as well. But you can see traders are scalping since it's a trading range. You get bad follow through on 10, and I think it's important that 11 trades above 10. Once 11 trades above 10, it becomes possible that 11, 12 is a second leg trap. Some traders are looking at this as essentially a trend line break, and they want to retest and then some sort of lower high. Some traders would argue that this is the lower high since this traded above that. but I think it's more likely that this is just going to end up being a second leg trap. You get follow, and you're right on the moving average too, which isn't great. You get follow through on bar 12, and it's probably pretty clearly always in short. But by the time it's always in short in a trading range, that means that we're probably gonna, you're probably gonna reverse. It's the opposite on trading range days. So you probably want to be, this is more of a buy zone than it is a sell zone on bar 12. 13, a big reversal up. It's a double bottom with 2 and potential second leg trap from 12. So you have trap traders and a strong double bottom. Also, 90% chance we break out of the 18 bar range. So if we go up for a couple of bars, which I think above 13, 60% chance you're going to get at least 2 legs sideways to up. Reasonable to think we're going to break out to the upside of the 18 bar range. Bad follow through on 14, but that's kind of expected. 8 through 12 was strong enough to probably get a second leg down. So you can't necessarily be expecting, great follow through. If you're buying above 13, you probably just kind of have to be willing to sit through a lot. 15, a bull bar reversal up, but not quite closing on a tie. More follow through for the bulls on 16. 16 closes above the breakout point of 14. So it's a breakout above the 14 high. And since it pulled back below 14, I think a lot of traders would have their stops below 15. I don't know if that's a mistake, but I think 19 was unusual. You do know that traders who sell below 12 are probably going to be able to scale in higher and make money. If you sold the close at 12, you probably could have sold more below 14 or at the low of 14. You can see those traders. Okay, so those traders were not able to get on a break even, which is interesting. But that's even more trap traders that you have. 18, small bar. It's 1, pullback, 2, pullback. So we'll see what 3 ends up being. And then you get a big surprise on 19. Trades all the way back down here. I think bulls are going to buy since it's around the bottom of the buy climax from here. It's also, essentially a retest of, the 12 low and down here. And so it runs a lot of the weak bull stops and then starts to go without them. And those traders, if you bought this breakout or something and your stop was below bar 15 or something, those traders are getting stopped out and then starting to go in their direction. And now they're panicking, trying to get back in, thinking that they just got trapped out of a good trade. And that's what's happening on 20 and 21. 20, you got a deep pullback, but again, bulls bought it. I think that actually kind of was more important than, people think. The fact that bulls bought at a 50% correction here, because that's kind of what bulls did all day. If you look, I haven't checked this one. Okay, so that maybe this. It was, it was more than a 50% correction here. But, if you look at the outside bar, 25, rather than buying the new high, bulls waited for it to pull back, bought around 50% correction. 27, bulls waited for it to pull back, bought around 50% correction. 30, I don't know if we quite got, if you just use around the body, it's a 50% correction. So, it's clear on these type of channel days, you have to realize that when the bull bars are getting bad follow through, it means that traders are more looking to buy pullbacks and they're looking to sell the new highs and they're scalping out. So they'll buy here and then they'll scalp out at the new high, and then they'll buy another pullback and they'll scalp out at the new high, and they're doing that all the way up. So bad follow through on 22, kind of expected. Retest the breakout point. Bad follow through on 23, but it is a parabolic wedge essentially, but it's possibly consecutive wedges, a couple legs up, but this is not a very good close on 22. And so a lot of disappointed traders not going to be looking to sell below 22. Bad follow through for those bears on 23, and reversal up on 24, trying to break out of the, get a new breakout of this range. You get some follow through on 25. Notice 25 trades below 24, so probably buyers below 24, which is pretty much to be expected. And outside up on 25. But traders more looking to buy pullbacks. You can see even here, they weren't really willing to buy as much above 19. They wanted to buy the pullback. They weren't really willing to buy the close of 21. They wanted to buy a pullback of 21. It's low, around the low. Generally, outside bars, traders prefer to buy pullbacks. So 27, big bull bar. Traders, like I said, bought a 50% correction on 28 instead. And you get another bull bar on 29. Notice a lot of these buys, the reasonable areas to buy above, like above 27, etc., like above, maybe above 25, they're not really triggering. And, that's another sign that traders are buying pullbacks. When you get these strong bars, they're just selling them instead. So disappointing follow through, 28, 29, a bull bar, but a big tail on the top. 30, it's potentially a wedge, but this bull channel is too tight to be doing anything other than buying. If you want to, you could exit below 30, but I think it's totally fine to stay long. If you exit below 30, though, you probably have to buy again above 31. Bad follow through 32. Like you said, you can see bulls selling the new high. Same thing with 33. It's an inside bar, but not all that great. Three straight bull bars though, so probably enough for a second leg, probably buyers below 34. Bulls are basically betting against bears. They're buying below 30, they're buying below 34, expecting, bad follow through, because, bears are generally going to get bad follow through in this tight of a channel. And if you're brand new to trading, it's probably pretty easy to get caught up selling below bars like 30 or 34, or even selling somewhere down here. But you have to, something I struggled with for years, still, sometimes, is the channels are, when the channel's really tight, you just don't want to trade against it in general. Sometimes it'll work, but those are specific situations and they're really hard to read, and it's just better better not to trade it, because even by the time you get the reversal down on 42, which I thought 42 was the most likely to get the reversal down, which I'll explain in a second, but even by the time you get the reversal down, you've lost 5 points here, 3 points here, you probably lose another 5 points there. So you're down like 13 or 14 points. And if you even have the mental strength to continue trading and take 42, even if you got it at the very low, which you're not going to, you'll barely make back what you lost, and you won't be at a profit. So it's really, when the channels are really tight, it's better not to trade against the trend. But anyways, bad follow through 35, follow through for the bulls on 36, another reversal down on 37. But again, these are all probably minor at best. 38, bad follow through for the bears who sold below 37, which is expected. 39, some follow through for the bulls, but not all that great. We're probably going to run bear stops above here though. And follow through on 40 and 41 for the bulls. But what do you notice about this 4 straight bull bars? When was the last time we had 4 straight bull bars? We haven't really yet today. This is the first time we've had 4 straight bull bars today. And it's some of the better looking bars that we've had today for the bulls. Not the biggest, but they're good looking. And so when you're 20 plus bars into a trend, and you get the 4 best bars that you've seen so far, and then you get a reversal down, that this is probably a climax, and there's a pretty reasonable chance we test the bottom of the buy climax. And that's exactly what we were doing on 44 and 45. But my overall point being, it's also a bar 42 reversal, right? It's exactly a midday reversal. So it's reasonable to think that we're going to get, I think 60% chance selling below 42 that you get 2 legs sideways to down. Now they could be sideways, right? It doesn't mean that this is going to happen. They could be sideways, but I thought in general we were going to get to the moving average. Follow through on 43. It's a pair of bars. I think any bulls who are still long are going to exit below 43. And that's part of why we traded down on 44. Traders bought the buy climax, the bottom of the buy climax, and scalped. More follow through on 45. It could be, 1 pullback, 2 pullback, 3. So, first off, 46 is a high one after 4 straight bear bars in a pretty overbought market. It's really not a good sell. And even if you bought 46, is 47 the follow through you wanted? No, it's not. You wanted, a much bigger bull bar, and that doesn't have a tail on the bottom. So even the traders who bought above 46 are going to be disappointed at 47 and get out really quickly, and that's causing 48. Can you sell 48? Maybe, but I don't think it's all that good. I think it's probably more likely, what's your premise really if you're selling 48? I think if you're selling 48, your premise is that we're going to get a big collapse. And if we're going to get a big collapse, then 48 is going to get good follow through. And so I think it makes far more sense to just wait and see if the low probability thing happens and we get big follow through on 49, rather than take the trade and then, deal with the difficult situation like you have to here. When you see 49 and, maybe I'm not a very good trader, but I'd probably just exit above 49 with a small loss. Some traders might scale in above 49 and then try to get out. But I think if you're selling below 48, you need to be really fast to get out, or you need to be willing to scale in. And I personally am not willing to scale into trades yet. 50, outside down. 51, it's 1, pullback 2, pullback 3. So it's a wedge bottom. Bad follow through though on 52. 51 never triggers, and 51 was unable to close on tie. We're also right on the moving average at this point, so it's probably going to be a trading range. 52 trades back up to the close of 51, and we get follow through to the downside for bears. 54, more follow through for the bears, but big tails, probably not all that good. Just seeming like it's going to get pulled back into the tight trading range. And, these tails on lower time frames, these are strong bull bars, right? So it's, up or down, up, down, up, down. So it could be some sort of, 2-legged correction, etc. And then you get a reversal up on 55, but not able to close on its high, and just really testing back into the middle of this tight trading range. A strong bear bar closing near its low on 56. And what bears are hoping for is a breakout below the bottom of the wedge. So a strong breakout below 51 and to get all the way down here. they're hoping that, ideally for bears, it would have closed below 51, below the breakout point, but it wasn't quite able to get below the breakout point. And bulls are defending their longs. So bulls about to close 51 are defending their longs, buying this low. Bulls are hoping that this is going to get essentially a failed breakout and then a reversal up, hopefully somewhere up here. Bull bar on 57, but not quite able to close near its high. You probably can buy above 57, but you can't exit below 58 if you buy above 57. I think if you buy above 57, you're probably going to get bad follow through a lot of the time. And so you probably just have to sit through it on 58. No surprise, you get 59. 60 trades back down to the bears who sold below 58. They're able to get out at break even during 60, which is pretty common since it's the trading range. Bad follow through on 61, and it's pretty sideways. If you bought above 57, I thought some sideways was acceptable, but you're looking for, a better breakout. And then bulls get a breakout attempt, but we're kind of just testing the top of the sell climax, and it could be 1 pullback, 2, pullback 3. So it could be some sort of buy climax and, essentially a parabolic breakout. It's essentially a triangle, right? And, traders are hoping that 66 is going to break out to the upside and get good follow through on 67. And, we're going to get back up here, but you get bad follow through on 67. And so I think a lot of bulls are going to exit below 67, which is what causes the big bear bar on 68. And then we pretty much just went sideways the rest of the day. I wouldn't buy above 72. I think bulls kind of had their chance here if they were going to go up. I don't think it makes sense to buy above 72 because you're buying, if you bought the close of 66, you did a reasonable thing. It wasn't great, but it was reasonable. So if you're buying 72, you're buying right where those other traders are going to sell because they got trapped in. If you bought here, you're disappointed in this and you want to get out around break even. So the traders who bought above 66 are probably going to exit around break even during 73, and that's exactly what happened, caused that selling. I don't think it was the best day for stop order trading. It's a trickier day for stop order trading, at least. It's hard to get in. You just kind of have to find a way at some point. Maybe 8 is an okay swing sell, or 9. 13 is definitely an okay buy, but you have to be willing to sit through a lot. And I thought up here you could be buying breakouts. So, big bull bar and a pullback, and then another breakout, and you could buy above this with a stop below 23. So, so essentially, 10 points of risk and just hold as long as it's always in long. Just continue to hold long and hope we get a swing up. And you could buy above this breakout with this, probably a stop below 25 and just keep holding long, but you're probably gonna have to sit through pullbacks. And I think you get out below 42. If you sell 42, I don't think it's a great idea. Just in practice, trading against a tight channel doesn't seem smart. And maybe there's some sort of sells in here or buys, but I just think this all just goes sideways. A lot of times bull trend days, they'll trend until the middle of the day and then just go sideways the rest of the day. On the daily chart, I think the traders who bought above here are happy with this, and they'll probably end up scalping out. I think that you're probably going to get disappointing follow through for the bulls who bought. What bulls want is more follow through and a strong close, another strong bull close, closing above this breakout point. But I don't really think they're going to get it. I think that this will probably get disappointing follow through on Monday. But I think pay a lot of attention to the high of December 1st on Monday morning. If we get a failure above there and a reversal down, I think it's a reasonable sell. On the weekly chart, we have 5 straight bull closes, so really good for the bulls. Extremely strong and surprising rally, definitely enough for a second leg. But I wouldn't be surprised if we need a somewhat deep pullback soon. It's pretty sketchy to be buying closes up here near the top of this trading range. I actually pulled this up earlier. I'll look at the yearly chart too. That's pretty cool. I'll pull up the SPX. So on the yearly chart, we have essentially, it's getting close to the end of the year, so we might try and do something to alter the look of the yearly chart, but we obviously have a strong bull trend. And, you have a big pullback here. So any bull who bought this close of 2021 might be disappointed in 2022. So if we get back to that 2021 price, they might try to scalp out around break even. And this is probably strong enough for a second leg down. I think we're probably going to test back to at least this area. And yeah, that's really it.